Okay, children, now we are in chapter number 20, that is called Methods of Measuring National Income. So far, we have understood various aggregates, that is GDP, NDP, okay, NNP, GNP. So, in the previous videos, we have discussed about the national income, the definition of national income, circular flow of income, okay, and their relation, the relationship of different agents that is present, okay, what is two sector model, three sector model, four sector model, open economy, closed economy, okay. So now it is time to understand the measurement of national income, okay. So measuring national income will help us to understand the economic growth of a particular country, okay, how much economic development has been made, okay, in terms of the numbers, that is in a quantified data, okay. So all those developments, growths, welfare, okay, it can be quantified with the help of measurement of national income, okay. So let us begin, okay. So in India, the task of estimating national income is entrusted with the Central Statistical Organization, that is called CSO. Okay, it's a department of Ministry of Planning and Program Implementation. Okay, and it's been noted that whenever you calculate national income, it is always calculated as this NNPFC. Okay, remember GDP is not national income. Okay, GDP is not national income. GDP, it is not a national income. Remember. Because first of all, G stands for gross, okay, but it is net, okay, domestic, but we are talking about the national product is same, okay. And whenever you are talking about GDP, it has two aspects. One is at market price and the other one is GDP at FC, okay. So but it is always at FC. In fact, it is in fact in GDPFC, okay. Let us assume that it is GDPFC. So we can make our own formula also. I will just show you out here, okay. GDPFC. How to find GDPFC? Now to find GDPFC, we have to get this, okay. NIT, that is net indirect tax, okay. I'm just showing you out here. I shouldn't have started with the formula, but still, okay, GDPFC. But what uh, we want this national income, isn't it? National product, NNP, NNP at FC. Okay, we found FC, okay, but this is NNP, net. We want to find net. So first we will find NDP FC. So NDP FC, GDP FC minus net. So which means you have to subtract depreciation, okay. I will tell you how to learn the formula, how to use the relationship between them, okay. Don't worry, you will learn. Now from GDPFC, okay, first of all, calculating this GDPMP is very simple. You can use any of the method, okay. So GDP, after calculating GDPMP, you can get GDPFC by just subtracting NIT, okay. And you want NDP because your ultimate aim is to reach NNPFC, because NNPFC is your national income, okay. If in a question, if you get like this, that calculate uh, national income, so they are actually referring to NNPFC only, so don't get confused, okay. I will tell you each and everything out here in this video, don't worry. So first you calculate GDPMP, that is the first step. After calculating that, you will get GDPFC, okay. Then you will go to national product, sorry, the net, Okay, sorry, net. Okay, and then after that we will go to national. Okay, so you can see out here, let us just fix it to GDP only. Okay, so this G, I mean the first letter, it tells you whether it is gross or net. If it is G, it is gross. If it is N, it is net. Okay, remember this very carefully. And the second letter, that second letter, it will tell you whether it is domestic or national. If it is D, it is domestic. If it is N, that is national. Okay, the third letter, it will be same as it is PPP. Okay, and this last, I mean the what do you say, mm, in exponents, uh, what is it called? I don't know. I don't know about mathematics much in great detail. Mm, but you are very much familiar with logarithms and all, isn't it? This number, which is at down, okay, this number, sorry, number, I mean the letters, okay, they will tell you whether they are at market price or factor cost. And in the previous video, just immediate to this chapter, that is in chapter number 19, we have already seen that these aggregates, okay, whether it be GDP, NDP, NNPFC, NDP, okay, GDP, MP. So, I mean, this GDP, NDP, NNP, GNP, whatever the aggregates are there, it can be calculated. I mean, it can be expressed either at MP or FC. That is MP for market price and FC for factor cost. Okay. So now, how to calculate national income? How to get all these? So this is why we are here in this chapter called methods of measuring national income. Okay. So always keep in mind that national income is always at NNPFC, that is net national product at factor cost. Remember, always. Now, there are three methods to calculate national income. Okay, you won't get immediate national income, but you have to derive national income from that part. Okay, always remember. Now let us go to the product method or value added method. Okay, so see, net product method or value added method. So under this, you will get this GVA MP equals value of output minus value of input. So this is the formula. GVA, it stands for gross value added at market price. Formula is very simple, value of output minus value of input. Whereas, I mean, where value of output is equals to sales plus change in stock. And what is sales? Sales equals to number of units sold into price per unit. Okay, the data will be given in the question. Okay, so according to the data, you have to use the sub formulas also. Okay, and how to find a change in stock? Change in stock is closing stock minus opening stock. Okay, and by value of input, we mean the intermediate consumption. Okay, purchase of raw materials. Okay, power expenses, etc. Okay, it will be mentioned in the question. Okay, but you have to identify whether it is a value of input or value of output. Okay, but value of output is very simple, sales plus change in stock. That's it. Okay, now this value added method is very simple. Okay, GVA MP equals to value of output minus value of input. But remember, this GVA, whatever you are finding, it is always at market price only. You will not get in the factor cost. Okay, and it is a gross value. Okay, so this is the formula that you must learn from the net product method. Okay, learn the formula. Okay, just write in your copy net product method or value added method. Write in your copy GVA MP equals value of output minus value of input. Write by yourself. Okay, so by writing, you will also learn the formula. Okay, now let us go to the income method. Now in income method, uh, yeah, and remember this, before I go to this income method, I just want to tell you that GVA MP, whatever the GVA MP that you calculate, is actually the GDP MP. The GDP MP that I was talking about in this particular thing. Yeah, this one, GDP MP. Okay. Now, this is actually equals to the summation of the value added by all the factors, sorry, by all the sectors. Okay, because in some question it may be given that value added, sorry, value of output by primary sector, secondary sector, tertiary sector, value of input, primary sector, secondary section, sorry, secondary sector and tertiary sector. Okay, so you have to combine all the three sectors together. Okay, you cannot, it cannot be separate. It has to be aggregated together. Okay, because we are talking about the macro level. Okay, we are talking about the macroeconomics, right? So you have to combine all the sectors together, be it primary, secondary, or tertiary. Okay, we will see this in the numericals. Now, this income method. Now, in income method is very formula is very simple. By the way, this is NDP at FC equals COE plus MI plus OS. That's it. Finished. Income method formula. Finished. Now remember, unlike your this value added method, income method is actually your net. It is not gross concept. Okay, in the income method. And in in the value added method, you would get answer at market price, but in the income method, you will get the domestic product at FC. Okay, income method and gross method, value added method, it is same, but there is a slight difference that from income method, if you want to go to this thing, gross GVAMP, okay, you have to add depreciation as well as NIT, that is net indirect tax. Let me just show you out here. Okay, now from NDPFC, okay, let me just copy this section. Okay, now, okay, now I want from NDPFC. Sorry, made a mistake. GDPMP, NDPFC. Yeah, now it is okay. Just okay. Yeah, you already have NDPFC. Okay, but from NDPFC you want to calculate GDPMP. Now this is net. As I already said, this the first letter, it will be, it will highlight, it will tell you whether it is gross or net. So it is already net. So you need to convert this net to gross. So when you net to gross, it will be depreciation. Okay, to be added, and it is at market price. So in market price, you must add NIT. Okay, so it's very simple. So you can convert. So you can convert this NDPFC to GDPMP or from GDPMP to NDPFC. Okay, it's very, the conversion is very simple. Okay, so this is the formula of income method. Now, yeah, I must explain you these things. COE stands for compensation of employees. Okay, it can be wages or salaries plus ESSS. Okay, plus salary in kind. Okay, so for example, if you are working in a company and the company is providing you the accommodation facility, okay, so that is your salary in kind. Okay, but remember that traveling allowances or traveling, that TA, it is not under the category of COE. Remember that part. Okay, because that TA, whatever it's allowed to you, you can only use for the traveling purpose only. But salary, you are free. You can use your salary for consumption purpose, or for like buying anything, or for any kind of entertainment, whatever you want to do. Okay, nobody will ask you about your salary, what you did with your salary. But that TA money, it should be only and only used for the traveling purpose. Okay, and the company, when it will make the account, it will be recorded towards the debit side of the PL account as traveling expenses. Okay, so this is the indirect expenditure for the company. So it is already out there. So something, some amount of accounts are also involved out here, but let us not go into it. Okay, Yeah, MI, mixed income, like person, uh, like teachers only. Okay, they earn from school as well as they earn from the tuitions. So don't you think it is the mixed income? And that teacher, he or she has uh, given her or his place as rent also. Now he or she is also earning the rent. So that is the mixed income of that particular person. Okay. Now operating surplus. Yeah, in operating surplus, we are actually talking about the institution for a company. We are talking about. Okay. So operating surplus is equals to profit plus interest plus rent plus royalty. Okay, so this is your operating surplus. Profit plus interest plus rent plus royalty. Now, what is profit now? Under this profit also, so many things are there. You know, undistributed profit, that is your reserves or retained earnings plus dividend plus corporate tax. Because this tax is a charge against profit. So in profit, it is to be included. Okay, if in a question, if profit is also given and retained earnings is given, then don't include retained earnings again, because in profit retained earnings are also, they are already included out here. So don't include separately. Okay, I will tell you when we do the numerical questions. Okay, now yeah, these are the full forms. Okay, so this ESS, that is Employees Social Service Scheme, it is actually this thing, that PF. Okay, yeah. So in this method, we exclude NIT and depreciation. Why we exclude NIT? Because we don't get at market price. Okay, because we get at this factor cost. So NIT should be excluded, and we calculate at this value net. So this depreciation has to be excluded. Okay, because this is the main formula. Okay, so you need to understand this part. But you can change your own according to the situations. Okay, so I will tell you how to change the formula and all. Now I'll come back to this expenditure method. Very, very simple. It's very, 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 very simple. Okay, expenditure method. Name is only saying expenditure method. Whatever the expenses that are made. CE, or you can simply write a CIG. Yeah, let's just make it no CIG. It will be better. Yeah, CIG. Yeah. So yeah. Okay. Expenditure method. So expenditure method again. GDP MP equals C plus I plus G plus, open the bracket, X minus M plus GDCF. Okay, so now remember, using both value added method or net product method and expenditure method, you get GDP at MP. But under the income method, you get NDP at FC. So remember this. It's very, very careful. Be careful with that part. Okay, now C stands for consumption expenditure. That is the personal consumption expenditure. If you are spending 2000 rupees for buying food items, that is your consumption expenditure. That is the consumption expenditure made by the household. Okay, I, investment expenditure. This investment expenditure is actually made by the firms. Okay, now G, government expenditure. Government also, they spend money. Okay, they also have to pay off the salary of their government employees, right? So that is the government expenditure. Okay, so government it constructs large dams, roads. Okay, so many things. So that is the government expenditure. And X stands for export and M stands for import. Okay, so that is the net import, net export we're talking about. Okay, so this figure, it can be both positive as well as negative. So it will be the net export. Okay, X minus M. Now GDP, GDCF. What is GDCF now? This GDCF is equals to, actually it refers to the gross domestic capital formation. How much of capital has been accumulated or formed in that particular country, okay, in that particular time period. Now to calculate GDCF, you must include depreciation plus change in stock as well as the net domestic fixed capital formation. Okay, because sometimes in question uh, net will be given. Okay, so in net you must add depreciation and change in stock, then you will get the GDCF, which is the part of the formula. Okay, and this capital expenditure, it actually means the purchase of capital asset, that is your investment expenditure. Okay, and this sometimes this depreciation is also referred as consumption of fixed capital. Okay, so remember this part. Okay, and you have to be very, very much careful that under expenditure method we calculate GDP MP, that is without subtracting NIT and depreciation, because it is at GDP MP. Okay, so till now we discussed three methods, that is value added method or net product method or simply product method, number two income method, and number three expenditure method. Right, now let us understand this section, national income, because we have to ultimately, when you use those formulas, okay, be it value added method or income method or expenditure method, you will get the domestic product. Okay, using value added method you get GVA, that is the GDP only. Okay, uh, income method you get net domestic product, however it is not gross, but if you add depreciation and NIT you will get GDP at MP only. Okay, and under expenditure method also you will get the GDP MP only, but you have to calculate NNPFC, that is the national income. Okay, so how to calculate national income? So calculating national income from a value added method, it's very simple, because we already know that GVA MP is equal to GDP MP. So in place of GDP MP, if you have, I mean, if in the question, if the data is provided as GVA MP, then write GVA MP out here. Okay, so don't get confused, because GVA MP and GDP MP, they both are same and equal. Okay, so to calculate national income from value added method, you must subtract depreciation, add NFIA minus NIT. Why we are including NFIA? As we discussed in the video, I mean the previous video about this FITA, FIFA, I talked about, right? I even showed you that picture of India, USA, and Nepal. I showed you the relationship, okay? FIFA, FITA, okay? The normal residents operating outside the country. Okay, so just to correct that part, okay, that time in that video while explaining that part I said to correct this, okay, we have to do something, and this is that something, NFIA. Okay, and since under the income method we are already at net. Okay, so domestic, so just to convert this domestic to national you have to add NFIA. Okay, and it is already at FC, so no need to calculate anything. And this thing, expenditure method, same thing, same as your value added method, minus depreciation plus NFIA minus NIT. Okay, and NFIA is equals to FIFA minus FITA. Okay, and the figure of NFIA, just like X minus M, you can see out here, net export. Okay, its value, it can be both negative as well as positive, right? So similarly the value of NFIA also, it can be both positive as well as negative. Okay, NFIA. Okay, remember that part. And NIT stands for tax or GST minus subsidy. Okay, that is how you calculate NIT. Okay, so these are the full forms. Okay, NFIA, FIFA, FITA. Okay, now I will show you the Brahmastra of this particular chapter. This is your Brahmastra. This is the Brahmastra of this particular chapter. Conversion. You know, I was very much easily I was able to do this part, isn't it? How could I do so? So have I learned the formula? No, I don't know the formula. I haven't learned the formula. Yeah, the basic formulas, that is the value added method, income method, and the expenditure method, that basic formula you need to learn. Okay, those three formula you need to learn. Okay, but what about these formulas? So should we learn this formula also? Should we learn this formula? Yeah, if you wish to learn the formula, then you learn. It's your choice. But how many formula you will learn. You have so many formula to learn in mathematics as well as now in economics also. Okay, so it will be better to use this Brahmastra, this conversion from gross to net. Okay, if you want to go from gross to net, you have to subtract depreciation. But if you want to calculate net from, sorry, if you want to calculate, if you want net to gross plus depreciation. Okay, similarly, national to domestic minus NFIA, domestic to national plus NFIA, market price to factor cost minus NIT, factor cost to market price plus NIT. So this is how I was able to, uh, you know, able to make the relationship out here. This is how I was able to make the own formulas. So please uh, learn this conversion table. Okay, this is not the table, but it's a conversion chart or flow chart, whatever you say. Okay, this it's not important. Yeah, this formula from expenditure method, income method, and ultimately the value added method, and that conversion table. And yeah, sub formulas are always there. So please, if you learn this part, okay, and try to understand. See, this particular chapter, this measurement of national income, you have to understand 80% you have to understand, and 20% you have to learn. Okay, at least you have to learn few things, no, because this chapter is about mathematics. Okay, so you have to learn 20% only, but remaining 80% you must understand this part. Okay, so please learn these formulas. Okay, then we will go to the numericals. Okay,